Good afternoon, everybody, and welcome to today's edition of Live Market Analysis. This time we'll be looking at the macro. My name is Carl Capolingua. I'm the market analyst over here at ThinkMarkets Australia. It's a pleasure to be with you as we check out the world of finance and try and figure out how it relates back to your portfolio, but potentially also to see if there are any trades in indices, commodities, foreign exchange, crypto. The format of today's presentation is very simple. It's over to you. It's ask me anything and I'll do my best to give you good technical and fundamental analysis. You should have a Q&A window somewhere on that Zoom window if you're watching me on Zoom, or if you're watching on any of the streaming services, that is YouTube, Twitter, LinkedIn or Facebook, you should be able to contact me as well. Let us head over to the charts first and foremost. And I'm going to kick off with a chart I tweeted this morning. It's one I tweet regularly because, well, I think for a long time, certainly through here, I was of the opinion that the NASDAQ was the riskiest of risk-on indices. And therefore, if there was going to be a calamity to befall financial markets, it would show up in the riskiest assets first, the ones that are the most interest rate sensitive. And lo and behold, around here, let's look at that break there, early 2022, it's really started to break down. The peak was 22.11, 2021. Now, if I go to a little bit of a different chart here, give me a second, let me find it. We'll see why that break occurred. And you can see there on that day, in fact, the bond market had anticipated it, with yields already on the rise. But that day was the day Jerome Powell was reappointed for his second term as chairman. I'm not pulling your leg here. The same day that the NASDAQ made its all-time high was the same day that Jerome Powell was reappointed. And in his acceptance speech there, he shuffled his papers and changed his stripes completely from ultra dove up to that point to an ultra hawk. And we saw rates lift off significantly from there and obviously killed the NASDAQ, one of the greatest bull markets I've seen in a career that spans now over nearly 30 years in November. It'll be the anniversary of me buying my very first share in Commonwealth Bank back in the float in 1993, the second tranche. So 30 years of watching markets, and that was a pretty nice turn. We saw, obviously, once the trend changed here through the traffic light system, it was not looking good, and I gave you indications in these sessions and in the media saying that the bull market is over, and it was around here I said that the bear market has begun because we failed at the long-term trend zone, which was acting as dynamic support so well up until that point. I mean, look how amazing it was at supporting price, like a cushion, this invisible hand pushing price back up. And then it turned, as it so often does, into this invisible hand pushing prices back down. Now, that's not a waste of time having that discussion, because it segues perfectly into what I want to talk about now, is that we've seen the reverse. And this is how beautiful trend analysis is. Everything you think for the upside, just invert it and turn it upside down for the downside. And vice versa. So now we have this trend ribbon here going from resisting upward price movement now to acting as that hand again, supporting price movement. So that was the first indication in me coming out back in February and telling you that the bear market was over, and then a little bit more recently waiting for the break of 12,270 to say to you that I think the bull market has begun. And really, I was wanting an emphatic break of 12,270. I didn't really get it through this candle here, and this candle here. This is great. That's a little bit disconcerting. And then wonderfully last night, I think that's our emphatic confirmation that we are in a new bull run. And there's so much fear, uncertainty and doubt out there at the moment. We call that FUD, which could, I guess, lead you astray from just trusting the underlying trend. And many people will say, hey, Carl, it's not a very broad-based move. It's only in a few big tech stocks. And look, I get that too. And we're going to investigate some of those factors today to get a better idea of just how we should be positioning our portfolios. But I think that looks very, very good. Obviously, there's going to be some supply points, some pressure points upstairs, 12,656. Let's see how the candles go there. If we start to see a bunch of black candles coming in, a bunch of upper shadows, I'm going to grow a little bit concerned. If we hit that level with a bunch of white candles, it tells us it's not a problem at all. There's still plenty of demand in the system. And as I've said to you in the past, I won't labor the point, but nothing makes prices go up faster and better than prices going up, because there are fund managers out there that are sitting on record cash piles, more cash than they've ever sat on before. And that cash at some stage, when the market starts to go up, will have to get in. It will have no choice, for better or for worse, for value, for expensive, for debt ceiling. It'll have to just get in, because it can't stay in cash if prices are going up. 13,181. If we're above that, then it'll be in the media that the bull market has begun. It won't just be me giving you these early warning signals. So that looks very good. We saw we did very briefly see that bond market chart, and I might just head over there now, and I'm sure we're going to get to gold later on, but I just know this is where I have my scratchings in that particular chart for my 2-year US bonds. And the other thing I think that's really important about last night's candle is that it came in the face of another pop up in bond yields. And in fact, really the last 4 or 5 days of strong performances from the NASDAQ in terms of the candles and the price action have come as bonds have been rising. So that's encouraging. Should we be worried about that rise in bond yields? I'm always worried about a rise in bond yields. Make no mistake, when bonds are going up, it ain't good for stocks most of the time. But I think what we're seeing here is a little bit of a realization from the market, more broadly speaking, that we are not going to get rate cuts this year from the Fed. Okay, the Fed's base case will hold out. They haven't believed it up to this point. They've been factoring in rate cuts, but they're starting to just adjust these rates higher to where they probably should be if the base case plays out. That is no rate cuts this year. Okay, so I don't think that's too ominous. I don't think that's something we need to fear, unless it starts to break, say, above 450, because typically with rates now 5 to 5.25%, the official cash rate, anything around that 50 basis point discount in your short-term yields out to 2 years is probably fine. So let us watch that with a keen and cautious eye, but not one where we're getting really scared about hanging on to risk at the moment. We'll take each chart as it comes, of course, whether we're here on Thursdays doing the big macro stuff, or we're doing the ASX stuff on Tuesdays, or we're doing the USA stuff tomorrow on Friday at 12 o'clock. Okay, that's I'm sure we'll get into some of the other items today. We'll stop with the big picture stuff and head over to your suggestions here. And I do have one coming in from Nicola asking for lithium. Of course, because we can't do one of these macro sessions without having a look at lithium. And let's kick off with the lithium carbonate. We can see this V-shaped bounce I've been speaking of in the media. Now, the price floor was about 250,000 yuan per ton, and that was set by those big Chinese battery makers. We overshot to the downside. We're overshooting, I think, to the upside, and let's see where we go from here. We're probably going to settle somewhere around here. I wouldn't be surprised if that V starts to sort of tail off a little bit around here, but I don't want to predict. I just want to tell you that the downtrend, I believe, is certainly the short-term downtrend unequivocally is over. The long-term downtrend, I have to say, is still in place, but I think with that V-shape, there's a very good chance that we can see at the very least stability rather than a return to those sharp declines we saw before. Okay, so that's a positive. The lithium hydroxide price is similar in that we are having a sharp-ish bounce here, not as severe as a lithium carbonate price because we have different underlying demand-supply fundamentals. Obviously, this is a refined product as well, where the lithium carbonate is literally, for the most part, and correct me if I'm wrong, because I'm not a chemist, but my understanding is you evaporate it in your salt lakes, you dig it out, put it in bags, and put it on a truck, and then a boat, send it to China. Okay, so it's going to look a bit different. It didn't fall as much, hasn't rallied as much, but I think again that's a pretty good situation there. Longer term, I don't want to talk about longer term. Let's just play it as it comes. Let us, while we're looking at some of these metals, I know this is more of an energy metal, But let us look at some of the base metals. So what we're going to do here, maybe picking up from our initial conversation about bull market, bear market, is look at copper. And will I go there or will I go here? I'm going to go here because I do have volume from my data provider on copper. And we might as well look at it if we've got it. So this is the copper chart. Last week, I'm pretty sure, if not maybe the week before, we were talking about, well, certainly we've gone from buy to get out of those buys to hold to sell. Maybe it was last week. I think we started talking about selling it. It has gone down a bit since then. It was certainly looking far worse on the 16 May bar there, closing at the lows. Last night's candle is unusual in that it engulfed completely. You can see the white body has completely engulfed the previous black candle. You don't often see those. I mean, go and check that. Prove these things to yourselves. But that's pretty unusual in itself. And look, whilst it didn't close at the highs, and in fact closing for me around this potential supply area here. And let me just make that color you can actually see, right? And maybe get rid of the dashed. I don't like that. So we've got a little mini intermediate supply zone there. The next supply is going to be here. Okay, and let me make that a bit bigger because it's still going to be influential, and that really is confirmed or supported by this area here as well. Okay, so I like to draw my boxes also. So let us draw where I do think we're going to be impeded to the upside. So whilst yesterday's candle is very bullish because that engulfing pattern is something you need to take note of. I do think there are going to be problems upstairs for copper, and I'll give you some numbers here. That low there is 381.65. I'm going to round that up to 382 and into this low here, which is 383. There's your problem zone. Okay, so whilst we stay beneath 382.83, I would suggest to you that maintaining a bearish stance on copper is the best thing to do. I'm totally respectful of the big show of demand from the demand side yesterday. Okay, maybe the market got a bit short, maybe there was some short covering, volume was elevated. Okay, we didn't quite get above this little point here. I think it's important at this point. That high there is 378. So first step would be 378, close above that, and then we need to get above 383 before we can start to be bullish. Until then, as I said, overall bearish and short term. If you wanted to, if you did get short, take a little off the table. I think you're very close to it. It's a very strong showing. Above 378, then I think you would get some off the table and probably a very small profit there, or a break even at worst, if that's the case. Okay, so watch for a close above 378. I just think it starts to get a bit too hard to maintain your shorts. I think you could then, if you were of the mindset that you wanted to get short, see how it goes in and around here, watch the candles there for a better entry to get short again. As for longs, no, they're off the table. I can't see any reason to be long copper simply on the basis that it's had one good candle, one bullish engulfing candle. Okay, trust the developing long-term downtrend there. Looking at some of the other growth metals here, let's head over to nickel. And I don't have volume for that one, so I'm going to head here and look at it. Where am I going to look at it? Maybe I'll look at it here. Let's go nickel. We only get a PM fix. That's the best way to look at it. We get a PM fix from the London Metals Exchange. We don't get candles, okay? So open, high, low, close. We get one price for the day. So best to look at a line chart. And the line chart looks pretty darn awful, doesn't it? So here's your key point of demand that we have now broken under. Come on, Amy Broker. Here we go. Key point of demand that we've just broken beneath. Let me label that one for you as a pod. And that level there was 21,900, let's call it. and that's 21,900 US dollars per ton is what we're talking about here on screen. And I would say as long as we continue to close beneath that level, there's nothing left to do here but trust the developing downtrends there. That looks pretty bearish to me. I can't see any reason to be long nickel. Certainly not that you can really do it, but nickel stocks would come into mind there if you're that way inclined. Let me draw a couple of other levels here that are just catching my eye as potential targets, potential places we may see demand come in. Maybe we do get a bounce from somewhere around here or somewhere around here, and I'll give you those values in a second to watch out for. So we'd be looking at something like a 20,000, obviously a big psychological number. That's 20,200 to be precise, and then this area here is at 19,100. So global growth picture, a little bit uncertain based upon that. And just for your interest, we won't do any further analysis, but to point out short-term, long-term trend. So it looks down on aluminium, looks very weak. And let's head over to some of the other ones there. Lead probably also breaking down. Tin struggling as well. And zinc, as I've said a few times in these sessions, looks the worst of them. One industrial metal that we haven't done yet is iron ore. Let's head over to here. And they're all in different places. So what's that one there? Where we just put our candlesticks back, can't we? There we go. We put our candlesticks back. And we've got Shanghai iron ore here. And I would, again, say that you look to trust the trend. I think we've seen something very encouraging here in terms of the price action. So we can see we're moving back into higher peaks and higher troughs, okay, albeit fledgling. You could go from there. I think that's a bit of dirty data, so I'll go from here. But you can see how the points of demand are just starting now to rise again. There you go. And the points of supply are being eclipsed. Okay, so that's good. And I was going to say the candles are good. Look, the candles are pretty solid from there. I wouldn't say they're great. This big upper shadow here is disturbing, certainly given where it comes in at that short-term downtrend zone, which on the way up, we know acts as an area of demand, but on the way down acts as an area of potential supply resistance. So again, trying to extrapolate this back potentially for your iron ore companies listed on the ASX, I can't say that we've made that definitive low just yet. And seasonally, what's more likely to happen is a bump around the bottom rather than a big rally from here. The strongest time of the year for iron ore is much later in the year. I think that's a pretty good look at those metals. Maybe there's one more here. Ravathi asking about Elders, which is an Australian company listed on the ASX. Ravathi, we're not doing those today. We do those on Tuesday. So come back on Tuesday and definitely ask me about Elders because I would love to comment on that one. But we will keep moving today. We can look at some of the agricultural commodities if you like, Ravathi. Perhaps we can do that later on. There's one I did want to mention there was the uranium price. And let me just zoom that out there with the weekly chart. And put on a line. You can see that one is still trending higher. We looked at one last week. It was a back adjusted chart, so it didn't have that spike in it, but the shape of the chart nonetheless is still absolutely intact. Let us maybe continue with this growth theme and head over to the oil price here and some of these energy commodities. You can see some of the scratchings we've had here in the past around going long. And I just tried to find this last week, didn't I? I couldn't remember where I put all my scratching, so it's actually on this chart. Go check the tapes. It'll be there. So you can see the plus 1/3, the plus 1/3, the minus 1/3, and it is a great example of how my model works. Never getting too tied to any theme that something's got to happen. The market will prove you a fool if that's the way you're going to behave. And you can see there some places to get out. This is a little bit like iron ore, and there's probably not a coincidence. They look similar in that we have had a bit of a double bottom pattern through here. Actually, the candles here look very good. This is extremely impressive. I mean, this shadow here really gets my attention. And last night's candle also confirms that demand is active in the system. So we're talking about this candle here. Would I go for a cheeky long here? We've got an OPEC meeting next week, I'm pretty sure. And we know that this gap up came from that meeting last time. It would be the cheekiest, most aggressive. You know, if I zoom this out, you'll see this is probably going sideways. And maybe you're better off looking at, say, a 4-hour chart or a 1-hour chart to get more trades on this. So I'll be honest with you, would I put my money on a long trade here? That's the way my brain is thinking, though, for a potential long trade. No, probably not for me. But if you are more risk-seeking, less risk-averse than I am, I can see reason for it based upon this shadow, the high point of demand, and the strength of last night's candle. But let's face it, I mean, it is still extremely bearish here with that short-term trend. Let me just fix that up. And the long-term trend, which is there. And fix that one up. Give or take, you get the picture. So I would say pass to do anything. Too hard basket. Natural gas, while we're here, is actually not there. And there it is. Still bumping around the bottom. Is there a long trade in the offing there? Kamikaze long trade? I don't think so. We've got a nice little point here. That high there, 252.90 with a big white candle. I can see that. Yeah, look, I mean, and again, this is a dip in the toe in the water sort of stuff. So we'd have higher, little high troughs coming in. The short-term trend's trying to change. Obviously, we know the long-term trend is down, but this is as I said, trying to really scalp something here. And let's assume we get a trough here, and then upon, I'm not around to tell you about it, let's say upon a close with a nice white candle. I know there's a few conditions I'm putting on this, but they're all sensible conditions. That high there is 251.5. Let's call it 252. So I can say here that with so close greater than 2.5, I should say 3 because it was 251.5, 252, with yeah, high of candle. It's the best way to put that. And let's put that over there. We'll leave that on the chart and we'll see how that one plays out. But keep an eye on it. If we don't catch it in the next session, might be the one after that. Let us keep moving then. Michael has a comment here from YouTube saying Biden had to enter the market to fill up the reserves. But Michael says that he thinks oil is going lower anyway. And, there was nothing in that chart really to confirm one way or the other which way it should go. I might head back here and just show you a couple of things. If you're thinking of maybe, there's that copper. I actually see copper just pushing up right now because this is a live chart. So you can see that really strong close, isn't it? Longs, gosh, you'd be so brave to go long here. But I do respect the strength of that last candle, second from last candle. So let's go natural gas here. I can literally just start typing it in and you're going to see those options diminish until we find what we want. It's actually just here on my watch list as well. So this is the ThinkMarkets, Trader trading platform. If you're unsure how you could trade natural gas, this is one way you could do it. You can see we've got the chart there as well. It looks a little bit different, and that might come somewhat from all back adjustments and the like. Let us say that maybe it was this high here, because it does look a bit different. Maybe that's the high there of 251.5. Probably is. Okay, but let's stick with my numbers on that one. Okay, and you would then simply open up your trade order ticket. You can see your amount here. Always like to just double click on that minus to make sure I've got as small as possible, because I get an idea of, well, if I want to trade the smallest contract, for each pip it moves, I'm going to make or lose 15 cents Australian, okay? Which doesn't sound like much, and it certainly sounds pretty inviting if you wanted to get involved, right? $35 is your total margin to have an opinion on this. What is the pip? Well, the pip is that last big digit is the 9. So if we go from $2.32.9 to $2.33, MBTUs, whatever the abbreviation is there, per US dollar, that would be the pip. Okay, so we are thinking, if we go back to the chart, of getting in here at 253 on a nice white candle, and if all goes well, then possibly we could see maybe even a move up to here, and that high there is, say, 327-ish. Okay, so if we were to place a stop loss on this one, you might be going somewhere beneath, well, we don't know where the last trough is yet, so it's all hypothetical. Let's just put some numbers in to make it work. Say 210 for 3. Oh, I've gone to the wrong one. Gone there, sorry. 210 for 320. Let's call it 210, 320. So if we go in here and then we put on our profit and loss and we go 320 for 210, just trying to give you an idea of how you could set this up. So let's put in an on stop order for now, just so we can say 250. 253. Okay, and we can see there at 253 we'd be risking $64 to potentially make $100. Okay, and try and find the so I'm not so sure. 253. I'm not sure why the numbers aren't matching up. Possibly the contract being tracked. Okay, so if that's the case, you would want to get some confirmation. See, that's that big candle up to 330. You can see where that matches up. Not sure what's going on here. Let's have a look. And it is possible that this chart on screen isn't correct. So 327, and then there's that little one there, and it's really here. Okay, just trying to match them up for you. It does highlight a practical issue here in terms of going from analysis on what the AMI broker data provider is giving me and what the ThinkMarkets contract is using. Okay, so we might need to do a little bit of translation here because there's that 330. That is now not 330, that's only 290. And it could come from back adjusting from the data provider, whether this is just showing you the last contract price without back adjustment. Okay, Google those words. They're all real words. 260 there. So really, it's actually a lot closer than I thought to a really purely speculative long here. And you might look at these shadows here at maybe close above 240. So when we said 253, it's maybe even more like 240. And when we are going for the stop, we would, I think, go at least beneath here and that low there. If I get my crosshair going, is 203. So probably you could be really conservative and go down there. But see, I'm loath to go at 202. I want to get beneath the round number. So it might be, say, 197, which is going to change that a bit. Okay. And then we're going to see our target up here towards sort of a 285-ish. I wonder then if we can make, we've got 1-to-1 reward to risk. And you can see on screen how it puts on your potential entry price. It shows you where your potential stop price would be and then your target price as well. Okay. Anyway, let me look into that and I will find for you an answer. That's not where I wanted to go. Force of habit. Find for you an answer on what contracts the ThinkMarkets platform's working off, and then how that relates back to obviously the data provider I'm using in AMI broker. But let us keep moving. Bitcoin from Anonymous. Let's head over to the land of crypto now, and we're going to head there. Look, it's in a bit of a holding pattern at the moment, isn't it? But I can see some positive signs coming in here. So the shadow here, I think, is a good thing. I think this candle here is also very important. Let me say that I can go a hold as long as we continue to close above that low there. So as long as we're not closing below say 27,400, I think we're okay. Beneath 27,400, you're probably going to see another look at 25,823, which is that low there. 25,823. And this candle low here is, if I said a different number, sorry, 26,564 is that low. So we're looking up here, 26,564. So if we close beneath, I might have read one of the other values there. But as long as we stay above 26,564, we're probably okay. If we can, where does it get to the point where maybe we can think about buying? It's a little peak here. And then there's just too much supply in here for me to be bothered, honestly. It would take a bunch of really solid candles from here. Maybe in the 28s. What's that high there? 28,334. Let's call it, say, a 28,350. Close above that, and it's going to start to look better. I mean, just imagine it closing above here with a nice white candle. It is just going to look better, isn't it? So 28,334, but maybe give it a little bit of room. We zoom out, you'll see that the short-term trend has been compromised, obviously. It is now officially down, in fact, and the long-term trend continues to hold. But yeah, it's hardly clear-cut. I do note, though, that when Bitcoin looks the worst, it tends to have a rally. Okay, Haraju's saying, I find that the web trader charts are a bit different, not all, for some reason, not sure why. Let me look into it. Let me get you a definitive answer on that. I'm sure it's just down to some of the data providers looking at like front month contracts. ThinkMarkets might be using the quarterly contracts, so the most traded contracts, and that's all it'll be. What we will find, though, 100%, is that the shapes of the chart are the same, because regardless of which month ThinkMarkets is using, which month this data provider is using on screen, they're moving just about lockstep. Okay, so they're still creating the same points of demand and points of supply. The moving averages, for the most part, are the same. What's going to be different is just the intricate little values of some of those peaks and troughs. And it's through that back adjustment process, when each new contract rolls off, that all of the old prices are changed. They're all manipulated by your data provider effectively, so that you get a continuous chart, a continuous back adjusted chart, rather than a spot chart for each month's contract, which only exists while it exists. And then once it expires, it never exists again. Okay. It sounds a bit complicated because it is. Futures contracts are complicated. Okay. That's it for the suggestions today. If you've got any, put them in now or forever hold your peace. Otherwise, we may adjourn. Short and sharp is always a good way to go. I think we've covered most of the big ones. Just while you're deciding whether you've got anything else to come in, we must discuss these two charts here, which is the regional banking index. Nicola, I'll look at coal for you next. So this is the regional banking index, and obviously black candle after black candle after black candle. I've been waiting for this big white candle to appear. It has. I mean, we've seen one here in the past. Okay, so let's not get too excited, but I think that's an important candle. I think at the very least, what it does is it sets for us this 75.75 as an important low. How important? Let me head back here and click it again, because I've got it all typed in better here. So you can see 75.75, that's the low. I think as long as we remain above 75.75 on the NASDAQ Regional Banking Index, we can have a bull market. I think if we close beneath it, I think we're in for the slipperiest of slippery slopes. So the charts I check every day now, okay? And in 6 months' time, it might not be the case. I might not be checking the NASDAQ Regional Banking Index, because that issue is not bothering markets anymore. By default, I go to my yields. That's where I always start my macro analysis. Bond yields, ladies and gentlemen, represent the price of money, and the price of money impacts every other asset class, every other security in every other asset class. So I always start with the bond yields. Then I might look at my big stock indices, particularly, as you know, I like the NASDAQ because it's a very risk-on market. I like to look at the Russell 2000. I'll head there next. Again, the really risk-on areas of the market. And the banking sector index is one of the ones I default always look at now. Okay, if we look at the bigger banks, okay, they're doing a bit better. They didn't go down as much, and there's a really nice candle closing almost on the highs there. And so you can see just a slightly better close than the regional banks. So that's a good thing. That's something that was really great last night. The other thing, let me just show you here the SKEW Index, and this is about looking at volatility in the markets. Actually popped up a little bit last night, but it's come off the highs. So this is how big fund managers are hedging themselves for a big downward move in the market. And it's called the SKEW Index because it measures the skew in markets, and I'm not sure if I'm going to be able to draw for you the skew. Maybe I can. So your typical, what does it say? Your typical, I'm trying to remember from my options, my years doing, studying options back at university. I'm trying to remember. Oh, you got the smile. Go Google the smile. But we ended up with something like this. Oh no, that's the normal. That's the normal. So we should have a smile. Yeah, we should have a smile where this is at the money. It's coming back to me now, ladies and gentlemen. Here we go. From Derivatives 325 at the University of Western Australia. Back in the early 90s. How about that? Some of you probably weren't even born back then. So that's our at the money calls. And then we go for our out of the money calls. I can't believe I actually remember this stuff. And well, both sides, aren't they? They're both of these sides are out of the money because the middle ones are in the money. So if we go out of the money, there you go. And what we noticed after the 1987 stock market crash, so that's how it looked since Adam was a boy, okay? But after the 1987 stock market crash, markets started to do this. Because what we found is that, and here it is, if you want to be long as a big fund manager, you need to have some downside protection. Okay, and the way you do that is by buying puts. And if you're a bit of a cheapskate, you'll buy out of the money puts, okay, to try and minimize that insurance cost. So what we found, so if we go, I should have drawn them different colors, but if we go pre-1987, and then we go post-1987, we found that the smile wasn't as prevalent. And we had this skew, and that's where the word comes from, this skew in how those deep out of the money puts priced. And on screen is what the SKEW Index is. It's measuring the slope of this curve. And if this curve is getting steeper, it means that there's more volatility being priced in, or implied volatility is the right word, into those far out of the money puts. And therefore, we're seeing more of that hedging behavior, more of that risk-averse activity in the markets. And this slope is increasing, as you can see. So whilst the VIX where's my VIX? There's my VIX. Aha, there's the VIX. Okay, should be your light bulb going, oh, wait a second, the VIX is going down. That means markets aren't worried about stuff. Okay. Well, the VIX is measuring the volatility of those near the money, those at the money, near the money options. It's measuring something completely different. It's not measuring tail risk, okay? And you're not using so much those options as much to hedge yourself necessarily compared to, say, what SKEW's measuring. So you can see the SKEW is going up. So the VIX is going down. On the surface, a lot of people say, oh, there's nothing to worry about. But no, the SKEW is going up. So that's something we can watch. It has come down off its peak. It peaked a couple of days ago there at 140. Now, the way this works is some extremely complicated maths behind this. But if you're at 140, you're looking at about a sort of 12.5%, 13% chance, according to the market, that we're going to have a financial calamity. Okay. Typically, it trades around 110. That's about a 2% chance, give or take, 2 or 3%. Don't quote me. If it was at 100, it'd be 0% chance. No chance of a financial calamity. Now, this peaked out over here at 170, back in just after the middle of 2021. Now, of course, we saw earlier on in this presentation how the NASDAQ crashed. The bear market began just a few months after the hedging activity by fund managers, and you had no idea they were doing this unless you're looking at the skew. But you can see that as we're heading into that peak, this fear that the Fed would lift off in rates could not stay where they were at zero, that they would lift off and potentially cause a financial calamity. You can see that hedging coming into play. And then we saw the big peak in the market. And go back and check the skew, and you will see these peaks in the skew each time before you've had one of those big market tops. Okay. What's different here is that we're actually getting the skew moving up, and we're not at a market top. We're closer to the market bottom. I can't remember a time when that's happened, but certainly it is saying that not all is absolutely well in markets. So just keep an eye on that. Okay, there's a few disconnections. That's not the right word. Discontinuities. I don't know. You know what I mean. I don't know how we got onto that, but you just got a lesson in options trading there. Options. What do you call it? Options valuations and volatility. I promised to go to Nicola's suggestion for coal, which is going to be, where is it? Actually, let's go here because I don't have in there the latest update for coal. I just haven't grabbed it, so I've got to go here, and you can't see it. You'll see it in a second when I find it. And there we go there. So we're going to go back to here. Coal, that's not where we are. That's where we are. Fast forward. Trend is still down. It's very clearly down. Short-term trend, long-term trend. There's nothing in the candles to suggest we've got anything wonderful going on the demand side just yet. Supply side still looks pretty much in control of this one, Nicola. So, yeah, I think the most likely path of price action here is to continue to the downside. I do note that there is going to be potentially a balance point around here. And you can see sort of as I'm hovering over it, it's that 137-ish, 138-ish, 143. And we're currently at 165. So there's still potentially $20 worth of downside, just over 1%, not huge. And if we zoom out all the way, and this is all the data I have here from TradingView, you can see that really is elevated probably compared to the medium term, and then the long term. I think a price around about 112, you can see around 115 is probably more likely the ultimate target for coal. Because coal is a bulk commodity. It's not like there's a limited amount of the stuff around. It's not like it's hard to find. It's not like it's hard to get out of the ground. It's not like it's hard to put on a ship and send to China. Okay, so yeah, there's no reason why this can't go back probably gradually to its long-term equilibrium point around 100, 120, okay, with maybe a stop at around 140 first, okay. Extrapolate whatever you want out to your coal companies for that, okay, but I can't see the spark, no pun intended, that is going to ignite coal. We haven't done, I'm surprised, Taraji, we haven't done gold, pardon me. We should have done it. Let us head back to here and to here and to here and zoom in a bit. Look, whilst I'm zoomed out, you'll see that obviously 2072.5 is a major supply area. We know that that is influencing prices here. It's no surprise to us that we're seeing a bit of resistance up and around the current area. If I do zoom in now, go back to normal, maybe a little bit more, that's X marks the spot, right? I think gold is a bit of a non-event for a while. Okay, not to say it can't get back into that trend, but I just think there's enough supply in the system from those black candles, from the price action having moved back into lower peaks and lower troughs. What am I talking about? Just in there. And in fact, looks like last week we said, look, just cool it. Just cool it on gold. Okay. We have been thinking long, but I'm pretty sure I wrote that last Thursday, minus 1/3. Take a bit off the table. Whatever you need to extrapolate that out to your gold stocks, extrapolate that out. And then if we're closing beneath 1969, you're taking more off the table. Probably getting out of this gold trade for the time being, okay? And I think that's been a pretty good piece of advice looking at Aussie gold stocks over the last week. I don't think my advice is going to change. I think 1969, a close beneath that, certainly with a low close on the session, a big black candle, and I think gold's done for a while. I think the market just got a little bit too enthusiastic and positioned to the upside. And when I see every person in the media telling you that gold's, the best asset in the world because it's so defensive and, you can sit on it with a shotgun, I just get a bit concerned. So yeah, this big black candle was the problem. That one there. See this shadow? And that's why I told you last Thursday that just to cool it. Silver is very much the same. In fact, I'm pretty sure my exact words last week, go check the video, were last week, species ending event. Okay, species ending event. There's nothing to see here now on silver. It's going to take some time and some really good candles to warm this one up again. Okay, to shine this one up again. Fertilizer grain meat from Jen. Sorry, Jay. I'm pretty sure it's Jen. Is it Jen? Well, let's look at some grains. Yeah, we can look at some of those. Let's head over here, and it's a bit of a mixed bag, to be honest, what's going on. And you can go here, and you can just see, again, this is one of the data providers I use. I've got the ability to back adjust the chart. I'm great. This is great. I'm glad we're here. So you can see this big gap, and what back adjusting does is it controls for, so right here is probably the contract changeover. It's not a demand supply event where the price collapsed. That's pretty unusual for grains, commodities to move like that. Not impossible for a gap, but it would take something that everybody heard about in the 6 o'clock news to cause it, right? A war, a hurricane, or, a drought. These big gaps here are more than likely, okay, going to be caused, and you can see they're both at the end of the month, no coincidence there, by contract rollovers, where you just start to print the new contract. And because time differences, seasonal differences, the new contract isn't always trading at the same level as the old one. And that's what we have this little button here called back adjust, okay, which then takes out all those gaps and gives you this one continuous price, okay? And there's been a debate for as long as there's been commodities as to which chart is the best chart, okay? But typically what we're using is the back adjusted chart, okay? So you can see just a click of a button just completely changes it. And that's why I was trying to explain to you before with all those words why the ThinkMarkets platform, and probably your own platform, whatever you might be trading on, that price might be a little bit different. Some of the peaks and troughs can be different because my guess is that ThinkMarkets is not using a back adjusted chart necessarily. And I can't confirm, I have to go ask somebody. Okay, but that's why we're going to see some differences there. That's all. It's very, very innocuous. But let us, while we're here, very quickly do this because we're getting pretty close on time, everyone. I'm happy to go the hour if the questions keep coming. So what we're looking at here is corn, okay? Probably had some corn for dinner last night. I know I did. There you go. That's a decent breakdown there. I mean, long buy, hold, sell, long or short. I'd be looking for shorts here on corn. I think you can add some risk on that right now. So minus 1/3. I won't type it in if you can find a way to trade it. I'm pretty sure we don't have it on here. So if I go corn, oh, we do. Oh, well, there you go. I stand corrected. And this is how great this platform is. So happy to add some risk here. And we're seeing what we're seeing. Let's look at this chart compared to the other chart. It does look very different, doesn't it? You can see the gap. There's your gap. We didn't see that other gap, but there was a big fall there. Maybe just the way it changed over, represented by a candle. But this looks non-back adjusted to me. But I still think you can short it. And I'll let you go and find those levels. So I'm happy to add risk there. If you've never traded corn before, you probably haven't. We're looking at this big 5 here. For every time that moves by 1 unit, we're looking at $1.50. So this is a big contract here, $1.50 move in Australian dollars, $80, not that big. Okay, so let us head back here. So we can trade that one. I'm pretty sure we don't have oats, not that I think there's a trade there. Rough rice, pretty sure we don't have that, but that's been a wild one, if that eventually updates for us. Doesn't look like it wants to. No, Not sure what's happened to this. Has never happened before, and I'm sure it's never happened to your trade view either, which is just frozen like that. So not sure what I've done to it. Oh, there we go. Rough rice. Maybe it just doesn't like rough rice. Weird. Okay. Well, let's skip past those for a very good reason. It's not working. This looks great. Cocoa. Now, I'm pretty sure we can trade cocoa. What a beautiful trend that is. That's amazing. So let us head back here and make sure we can trade cocoa. We can't. No, we can't trade cocoa. That's a shame. So in commodities, it's not there. Frustrating. Not saying we have everything on the platform. Cotton, I think, actually looks really interesting. I like this big white candle here. I actually like that. I think I could add some risk to that quite happily. Plus 1/3. Cotton. We got it. We can trade cotton. Let's check that one out. You can see, I think I just answered my own question. Did you see how that, when it flashed up for a second, it had an expiry date? It said July 2023. So I've answered my question. So this is not the back adjusted chart. It's going to look a little bit different. You're going to have to work out where some of your peaks and troughs are to work out your stops and targets. That's all. Apart from that, it's just, am I going long or am I going short? I think that's pretty simple from there, okay? And, well, this very small contract here, look at this 0.01. You can go as much, as little as 2 cents Australian for each move in the 5 part, okay? So we've got that one. Let's keep going here. Let's go to coffee. Now, we don't have this particular coffee because that's coffee Arabica, but we definitely have. I'm going to skip past lumber, which I know we don't have, and head over to here, Robusta coffee, which I've talked to you about in the past. I'm pretty sure I mentioned it for a long around here, and we went through that process of working out the buy. And I'm sure none of you got on board, okay? Because you said, hey, I've never traded coffee before. Why would I trade coffee? Well, you would have done very, very well if you had taken that trade. But I think you'd still can do very well on this one. I'm happy plus 1/3 there. It's a bit of a ways away from my light green zone, but it is a monster, and happy still to continue to be adding risk on coffee, if by some freak chance you did buy it based upon my analysis a couple of months ago, maybe more now, then I think you can hold on to it. Sugar, which I'm pretty sure we looked at as well for a long. You would have done well out of that one. You can probably looking to lighten the load a little bit on sugar. Then we get into our energy commodities here, of which we have discussed some of them. There's our Brent, well, there's not our Brent crude contract, but you can trade Brent crude with us. You can trade natural gas with us. You can trade West Texas crude oil with us. Okay, really interesting, I think, whip around the grounds there. Peter, I definitely want to do yours, Peter, because you actually nailed this one last week. I'm pretty sure it was you that gave me the Nikkei, where if I head here, you can see we did in our discussion, call it plus 1/3. I said, add some risk on the Nikkei. Hopefully you did it, because if you're getting in around, well, let's have a look at it, because 1 week ago, we would have been probably around here or here. Let's say you were buying at around 29,000-ish, and you're making you're making over 3,000 points on the Nikkei. I think that's a pretty good swing for you, Peter. So hopefully you did get on board. And if you're not sure how that all plays out, I didn't go back here. I have to go back here. Sorry, change the screen. There's the Nikkei. And you can see where we added a third around that 29,200 last week. And if you were clever enough to go and extrapolate that out to here, I'm not sure if I have the Nikkei here, but let's go Japan. I reckon Japan Nikkei. There you go. It's different ways to slice and dice it. But let's grab that one. Oh, amazing. And you can see here that the minimum contract size is 10, and all that equates to, all you really need to know is the pip cost. That's where I go here. 11 cents Australian per pip. And if you made 3,000 pips, well, do the maths, right? So if you made 3,000 pips times 0.11, well, it's not rocket science. You made $330 on the minimum contract. Okay, not going to rock your world, but I don't think it was that hard to go from the chart to then saying, well, this is how I take advantage of it. Now, for everybody out there that's listening to me that's holding 4 big resource companies and 4 banks, maybe you need to get outside your comfort zone a little bit. And all of this is available at your fingertips from this platform that just keeps flashing 24/7. It just keeps flashing. There's stuff out there to trade. And even more than that, you can use the stuff I've taught you in technical analysis to go to a 1-hour chart and everything's the same. Look at that. Nothing changed. The technicals are the same, right? There's your buy right there. I mean, look, that's probably that 29.02. That's where we looked at it last week. There's your buy, right? How is that any different from anything else we've looked at? There's a world of opportunity out there 24/7, just waiting for you with a ThinkMarkets account. There's the big plug. We've done gold. Thanks to Rees. G'day, Max. G'day, Carl. With what you've just discussed, would gold be a hedge against the skew? Oh, you got me there. No, I don't think so. I don't think gold is a hedge against the skew. So the problem with gold, Max, let me tell you what the problem with gold is. Okay, why has gold been going down? Everybody told me gold was going to go up. In fact, Carl told me gold was going to go up a while ago. Why did Carl tell you gold was going to go up? Because Carl was watching his chart, and the chart said that there was more demand than supply. So up to this point here, I was telling you to buy gold. Okay, and then after literally that candle, or that's silver. I told you not to bid it. So let me just do that with gold. Sorry, up to let me go here. Literally, go check the tapes. Up to there, I was still telling you to buy gold. Then I saw this candle, and I said, something's not right. Okay, let's go flat on gold. Now, the problem with gold is the chart I showed you earlier on, Max, which is this one here. So you can see, I should have left it there, because exactly at the point that these rates started to go up, gold started to go back down. And gold hates it when rates go up. It hates it. Also, the US dollar rallied. Why? Because rates are going up. So some people say, gold's gone down because the US dollar rallied overnight. Nah, the US dollar rallied overnight because rates went up. Okay, when rates go up, people want to own the US dollar. It's a higher return on that currency. So you asking me, okay, because people are hedging themselves via the skew, or the skew is telling you, that's not right. I said that wrong. People aren't hedging themselves via the skew. That's not true. The skew is telling you people are hedging themselves using far out put options. Okay, that's what the skew is telling you. That's got nothing to do with gold. Okay, so don't go, skew's going up, better buy gold. Please don't do that. You need to look at this chart here, Max, and say, interest rates are going down. I better buy gold. Okay, that's the way you need to think about gold. So you're asking me, how do I hedge myself against the skew? Well, the skew represents as we said, a 13% chance of a financial catastrophe. Now that also means an 87% chance of not a financial catastrophe, Max. Okay, so we can't look at the skew and go, oh no, the sky's falling. The sky's not falling. The skew represents people going long, Max. You have to get your head around that. The skew is not always just doom and gloom. People are going short because remember, it's a hedge. So the reason why possibly also the skew is going up is because this is going up. Okay, so people are buying stocks. Now, ordinarily, you wouldn't need to buy as many far out puts, right? Because you're not worried about stuff. Why are you worried about stuff? Of course you're worried about stuff because of this. That's why you're worried about stuff. But you have cash, as I said at the very start of this conversation, and you have to get that cash to work when prices are going up. So fund managers are buying NASDAQ stocks. Yes, it's only a small group of NASDAQ stocks at this point in time, but it is getting better. Check my tweets this morning. Because they're buying stocks, they are going to those far out put options to hedge themselves. And that's what the skew is telling you. So don't look at the skew and go, the world's coming to an end. 13% chance of calamity, I have to buy gold. That is the wrong thinking, Max. I think that is faulty thinking. Okay? But I'm glad you asked because it gives me the chance to maybe expand upon it. Hey, that's just my view of the world. I could be wrong. I'm just one talking head. Look at me in that little box in there. In here, look at me in here, talking away. I'm just a talking head. Okay? The difference between me and the other talking heads is honestly, I have no idea what's going to happen next. I wouldn't have a bloody clue, ladies and gentlemen. Anything can and anything will happen. I don't know. And once you get to the point where you don't care about the fact you don't know, that's when you can start to just follow the damn charts and get out of the way. Okay? Get your head out of the way. Get your thinking out of the way. It's not going to help you. Stop thinking. I think that's enough for today. Nicholas saying, thanks for doing these webinars, Carl. Had never heard of the SKEW Index before. This should be a weekly check-in. Let's have a look at it every week. But again, the skew can be skewed. in terms of what it's telling you. Okay, let's head over here and over there. Here we go. And say that we continue to do these sessions every Tuesday for the ASX. I know Ravathi asked about elders. Hey, come back, Ravathi, on Tuesday at 1 o'clock. I'll talk to you about elders. Today, we talk about macro. And wow, I enjoyed today. This is hands down my favorite session. Hopefully, you're enjoying it too. If you think somebody can benefit from being here, send them that link and say, hey, look, come and hang out with us just for an hour and just get a different view of how the markets work. And then tomorrow, we're going to look at USA stocks. Okay, if you're not a client of ThinkMarkets, you really should be, because we are the good guys in the broking scene. We have all those amazing products you can trade 24/7. It just keeps flashing away. It never stops. Plus, you can do your boring old for banks and for resource companies if you want to as well. We are an award-winning broker. We're regulated all over the world. We've got offices all over the world. If you're listening to me from all over the world, Google us. There's probably an office in your country, certainly. Maybe it's not that far away from where you live. World-class trading apps, as you saw, dedicated account manager, 24/7 support. Hey, and my analysis from time to time. Head to www.thinkmarkets.com/au for details. If you're watching me on YouTube, hit the subscribe button, because I'm always posting new video updates, and that'll keep you informed of when they go live. And hit the thumbs up button to let me know you like what I'm doing, so I'll continue to do more of it. Apart from that, it has been a pleasure chatting with you today. All the best for your trading and investing. Till catch up again. Bye-bye for now. Wasn't going to go there. Let me. Hey, there is an event coming up. We'll talk about it another time because I'm over time. But I must mention the disclaimer, which says that everything we're going to talk about today or have talked about is general advice. Please consider it carefully or consult the help of a financial professional before you act upon it. You can learn more about ThinkMarkets, and you should learn more about us by downloading our product disclosure statement, our PDS, from our website.